Tom Lee has a huge message for investors. Check this out.
The stock market has had 6 stress tests in the last 5 years. Okay, that's unusual. These are what I would call black swan events. You normally expect these to happen every 10 years, but we had 6 of them in 5 years. The first was the COVID shutdown. And then in 2021, after the economy was shut down, we had the bullwhip supply chain effect. You guys remember that. Suddenly factories turned on. There was a lot of confusion, a lot of ordering, a lot of shortages. Nobody really knew if things were short or demand was too high. Then we had a massive inflation cycle in 2022. And then the Fed followed that with the fastest Fed hikes in history, which caused a heart attack for the economy. And then in April of this year, we had the tariff global disruptions, which was the same as the Cuban Missile Crisis. We had the entire world watching for a single moment, and it slowed everything, and it caused a stock market crash. And then in June of this year, the US bombed Iraq's nuclear facilities, which, if you take any of these 6 events, and before any of them happened, if we said this will happen in the next 12 months, almost all of us would have agreed each of these would have caused a recession and a bear market. But instead, the stock market survived, and this is the PE, the S&P. You can see the equal weight of the market, PE, is now 17 times. Now, some of you might say that's expensive, okay? But I disagree, because the PE, the S&P, was 18 times before any of these black swans happened. So the market is cheaper today after 6 black swan events. But here's the point I'd make. You had 6 black swan events that should have wiped out the stock market, should have wiped out profits, caused a recession, but the economy survived and the stock market survived. I would argue the PE of the market should be going up. And that gets us to the next point, which is I think there are 2 reasons to expect US growth to outperform expectations. The first is that AI is still in the early stages. Okay. I'm just pulling up numbers. These are estimates for IT spending around AI, but IDC just published their most recent report, and they are forecasting 1.3 trillion of spending by 2029. I mean, that's a huge number, okay? And look at the level of growth compared to where it is in 2024. That, of course, is a huge driver of spending. And yet the stock that's probably the most important and a beneficiary of that is Nvidia. And you can see here it trades at 26 times earnings. Now, some of you might look at that chart and say, wow, it's 26 times. This is expensive. Now keep in mind, number one, this is the scarcest company in the world today. They sell a product that every AI company that's going to spend $1.3 trillion a year needs. There really isn't going to be a $1 trillion LLM without using Nvidia. And yet it trades at 26 times earnings. By the way, Costco trades at 49 times earnings, and Walmart trades at 39 times. So in a way, Nvidia would have a higher multiple if they sold membership cards or rolled back prices to $9.99. But you get the point. If Nvidia traded at Costco's multiple, the stock would be over 300. I think Costco is a lot less scarce than Nvidia. So if you ask me, if Nvidia is cheap, the AI trade is still massively undervalued. And there's a lot of productivity. Google, this is a CNBC story. Google's eliminated 35% of managers overseeing small teams. That's productivity. Now, there's a lot of people that say that this is an AI bubble.
Yes, there are a lot of people who think this is an AI bubble. Here's one of them.
AI is not a problem on its own. It becomes a problem, however, when the spending is being financed through debt. And that's what's happening right now. Google alone has accumulated $10 billion of debt just in 2025, Meta $28 billion since 2022. Microsoft's debt pile has jumped from $27 to $46 billion just in the past year. Oracle, now one of the biggest names in AI, is carrying close to $90 billion of debt and ramping it up every quarter. Just in 2025, US tech firms have issued about $157 billion in bonds, which is a 70% increase compared to last year. According to JP Morgan, AI-related debt now accounts for 14% of the total corporate debt market. If you know anything about how debt works, you'll know that this is money that needs to be paid back with interest. So in other words, companies that are borrowing to spend on AI need AI to produce a return on investment to justify the debt that they have taken on. And today, the reality is that the short-term return on investment of AI is extremely questionable, which could lead to financial pain and defaults once the debt comes due. We saw something very similar happen with internet stocks in the late 1990s. The top 10 largest companies in the US were spending billions of dollars on internet infrastructure fueled by the excitement from investors, just like today. These were companies like IBM, AT&T, Cisco, Walmart, Intel, General Electric, and Microsoft, all stocks that were melting up in the late 1990s. Many saw the situation for what it was, a disconnection from reality. We selected a few articles from back then that were warning about stock valuations not being supported by fundamentals, that many tech companies were spending enormous amounts just to keep up with a constant change in the industry, and that expectations had become detached from financial reality. Stanford University published a report cautioning that the technology sector had grown so large that it was creating structural imbalances in the economy. And finally, Nobel Prize winning economists like Robert Shiller were also expressing concerns about speculative behavior in the tech sector. And as history would later prove, all of these concerns were indeed entirely justified. The Nasdaq 100 lost 80% of its value from its 1999 peak, and many smaller tech firms went completely bankrupt under the weight of the debt that they had taken on. But notice the dates on these articles. This is from 1996, and these two are from 1997. If we look at a price chart of the Nasdaq 100, it was right at this moment. Internet stocks were already in a melt-up in 1997. That was the moment where internet stocks began to go parabolic. But the peak of the market only came in March of 2000, a full 3 years later. This is a perfect example of how the market can remain irrational longer than you can remain solvent. Traders who joined the party in the late 1990s made a fortune for multiple consecutive years. Of course, many of them lost everything when the bubble eventually popped. So is the AI bubble closer to 1996 or 1999? Well, we actually know exactly what triggered the implosion of the bubble in 1999. If we put the Federal Reserve's interest rate on top, we see the US central bank was generally lowering their interest rate during the late 1990s. This created looser financial conditions that made investors confident they could safely continue bidding up internet stocks. In 1999, however, they began to raise their interest rate in an effort to cool the market down. And it worked. The bubble popped and it unwinded. We think we could be following a similar playbook today. If we look at the semiconductor ETF in 2025, which is arguably the most AI-related basket of stocks, we see that it's also going parabolic right now as its rate of ascension seems to be accelerating. If we add the Federal Reserve's interest rate on top, we see that they've also been lowering interest rates recently, helping fuel speculative behavior. As long as the Fed keeps rates low and steady, it's likely that the speculation will only ramp up from here. When the Fed decides to begin raising interest rates, however, we'll know that the peak is very close.
People are calling AI the next dot-com bubble, pointing to billions in debt and warning of an 80% crash. They're comparing today's AI spend to the late 1990s internet infrastructure build-out that ended in disaster, but this comparison misses two critical differences. First, 1990s companies were building infrastructure hoping demand would show up today. Today's infrastructure is being deployed for customers already here paying billions right now. Second, companies like Meta aren't gambling on AI as some future bet. Their entire existing business today already runs on AI. Every ad, every feed, every dollar of revenue flows through AI systems today. AI infrastructure produces immediate utility and revenue today, unlike 1990s internet infrastructure that was purely speculative, hoping demand would eventually show up. The argument claims AI spending is like the dot-com bubble, where companies borrowed billions for infrastructure spending without proven returns. This comparison completely misses the fundamental difference between the two eras. In the 1990s, companies laid thousands of miles of fiber optic cable, hoping traffic would eventually justify the investment. They built data centers for services that didn't exist yet. They spent billions on infrastructure with zero immediate return, betting that demand would materialize in some distant future. AI infrastructure works the opposite way. Every GPU purchased today gets deployed immediately for workloads that are already generating revenue. Companies aren't building capacity hoping customers show up. Customers are already here, demanding more than can be supplied. ChatGPT has hundreds of millions of weekly users right now. Enterprises are paying billions for AI services today. Cloud providers report AI as their fastest growing revenue segment this quarter, not in some hypothetical future. The dot-com bubble was build it and they will come. AI infrastructure is they're already here and we can't build it fast enough. When Nvidia sells out every GPU they can manufacture and customers are willing to wait months for delivery, that doesn't seem bubble-esque to me. That seems like a supply shortage driven by real paying demand. Now let's dive into a specific hyperscaler. Meta's entire revenue is already AI revenue because they've transitioned their core business to run on AI infrastructure. The bubble argument treats AI infrastructure spending as separate from core business operation. For example, citing Meta's $28 billion in raised debt since 2022 as evidence of risky speculation. This completely misunderstands what's actually happening at Meta and other tech giants. Meta isn't spending billions building some separate AI business hoping it pays off eventually. They're converting their existing profit-generating infrastructure from general-purpose computing to accelerated computing. Every dollar of Meta's revenue already flows through AI systems. Think about how Meta makes money. They show ads to users. Those ads are targeted using AI models. The content users see in their feeds is ranked by AI. The videos that go viral are surfaced by AI. Content moderation protecting the platform runs on AI. Every single revenue-generating interaction on Facebook, Instagram, and WhatsApp is powered by AI infrastructure right now today. Do you see what I'm getting at? So when Meta spends billions on GPUs and AI infrastructure, they're not gambling on a new product, they're upgrading the engine that generates the entire $150 billion of revenue they generate. It's like saying an airline taking on debt to replace old planes with fuel-efficient ones is speculative. No, they're upgrading their core asset that produces all of their revenue. For me, the ROI doesn't seem questionable at all. Meta has publicly stated that AI improvements to ad targeting directly increases revenue per ad impression. Better content ranking keeps users on the platform longer, creating more ad inventory to sell. More efficient content moderation reduces costs while improving user experience. These aren't future benefits, they show up in quarterly earnings right now. The transition from general purpose to accelerated computing isn't optional or speculative. Companies are faced with a fundamental architectural shift that makes everything cheaper and faster. Running inference on GPUs instead of CPUs is 10 times more efficient for the workloads that drives Meta's business. Not upgrading would mean competitors who do upgrade can offer better products at lower cost. This is why the debt comparison to .com is backwards. .com companies borrowed to build businesses that didn't exist yet. Meta is borrowing to upgrade infrastructure for a business that's already one of the most profitable in history. One is speculation, the other is necessary capital investment to maintain competitive advantage in an existing, proven, massively profitable business. The short-term ROI is questionable claim falls apart when you realize that Meta's operating margins have actually improved while making these AI investments. They're spending more on infrastructure while becoming more profitable, not less. That's what happens when you upgrade to more efficient systems. Costs go up initially, but unit economics improve immediately. Ads are expensive and people don't trust them anymore, but they do trust YouTube. That's why 3 of our clients now make $100,000 a month for their business from growing a YouTube channel. If you run a business, book a call with me and I'll help you map this out.